Hello everyone and welcome to another episode of Decoding with Finsec. Today we have Mr. Pramod Rao and it's an honor to have you with us, sir, today. Before we get into, the minor details or, the finer details of things, let me first introduce you for everyone who doesn't know you, which is rare in our world. So Pramod sir has served as an executive director of SEBI, where he handled key functions including corporate finance department, more importantly, the Department of Debt and Hybrid Securities, and handled a lot of inter-regulatory work. He's also been part of the quasi-judicial cell and acted as a quasi-judicial authority and member of ISCO's assessment committee. He has held several significant regulatory and policy roles, including the membership of IFSC Authority and NAFRA, to name a few. Furthermore, he has extensive experience in the Indian financial services sector. He has previously been Group General Counsel with ICICI Group, General Counsel for Cities South Asia Cluster, a partner at Indus Law, and of course, General Counsel of ICICI Bank. In addition to serving on the boards of several ICICI Group entities and key industry and regulatory committees, Sir has also deeply engaged with fintech, lawtech, digital public infrastructure, and has also co-founded a lawtech startup. He has also mentored and advised various startups across leading institutional platforms, and also has advanced online dispute resolution and digital ecosystems such as Sahamati, Sahai, and ONDC. Sir is actively involved in legal education and access initiatives, including IDIA and the NLSIU Alumni Association, and has been a regular contributor to the law and policy discourse through leading legal and business publications. So that's a long list, and I have also edited a lot of it. So thank you so much for coming to our channel and joining us for this conversation.
Thank you for having me. Hopefully, I will contribute meaningfully to the dialogue you have planned for me.
Absolutely, sir. So, sir, we both have actually been part of, the initiative of online bond platform providers. And before we go uniquely into the retail side of OBPPs, as we call them, and the debt market in general, I have a few questions on my personal from which I really want to ask you.
Sure.
Right. You have moved from being a counsel and general counsel at ICICI Bank, Citi, all these big banks, and now you previously went to SEBI as a regulator. As every counsel and as a personal counsel myself in the past few years, there's always been this sort of thought of how a regulator thinks. How do they sort of collaborate with business strategy and business goals? How was your thought process when you moved from the group counsel, general counsel side to the regulatory side of SEBI? And how did that sort of reshape the way you thought in terms of innovation, risk, and market behavior? Did you feel that when you were a general counsel, the regulator was maybe behaving in a way you would not have? Or did you sort of sympathize more with the regulator when you moved there? How did that thought process go?
So, I was very fortunate in some senses. When I was at ICICI for my second stint, as it were, there was a lot of digital public infrastructure initiatives where ICICI got invited in to participate.
Right.
And I became part of some of those initiatives, both thinking through around those initiatives, especially from what I call an ecosystem perspective, not just as a participant in that infrastructure. So, you could have gone in and just thought, okay, I'm a banker or banker's lawyer, so therefore let me only look at that perspective. But I think participating in the DPI gave a 360-degree view of what each ecosystem participant was sort of going to interact with and experience in the infrastructure process. I think that opened my eyes to what difference one could make at an ecosystem level. So when the SEBI opportunity came along, I looked at it as now a market-wide impact opportunity. And I think I wasn't disappointed at all. So there are 2 or 3 aspects to SEBI, and I think especially a securities lawyer, all of us will immediately begin with the preamble to the SEBI Act. So there is indeed both the developmental role, there is the regulation role, there is the orderly conduct which you want in the market.
Right.
I think I got a flavor of all 3 at some level or the other. I got a chance to play developmental role in some senses, expanding the regulatory perimeter. OBPs were part of that. ESG rating providers was another, and so on. So one got to see that role and how to nurture something, municipal bonds being promoted, and The regulation hat in terms of them saying, okay, these are existing regulations. How do you enable them for ease of doing business? And I think that philosophy stemmed not just from within SEBI leadership, but even from our honorable finance minister and the call from PMO. So at many levels, you were part of some of those journeys. So I think it engendered both the spirit of private sector, if you will, but also innovation being nurtured, also development in the market being sort of geared up. I think all of that is how I would describe that journey exactly.
Lovely. And do you think during your time as GC and then from moving to the regulator, um, your experience or what a general counsel experience from a regulator's perspective changed? Has it sort of expanded over the years? Would you say there's been some new insights or outlooks on how the regulator views businesses these days?
So I would say yes, for sure. I think, no matter how, but if you are just working with a enterprise, you tend to look at the world with that enterprise's outlook. Right. How do you protect its interest? How do you advance its interest? How do you safeguard and so on? And I think moving to a regulator straight away gets you into being able to look at each participant's interest. How do you balance the interest of an issuer versus an investor versus an intermediary? I think that was a mind expanding experience for sure. So I look at it as I got a perspective which I think at least I've enjoyed and felt quite privileged to sort of have that.
Lovely. And that's very interesting to know. And, from there, from that experience, moving on to some of the key changes you brought on. And let's talk about how the Indian debt market has grown before we, jump into the retail revolution. So India's bond market right now is approximately 238 lakh crores, which is a huge jump in the last, 4 or 5 years. Are we finally seeing debt become a mainstream asset class for households, do you think?
So, I would tend to say yes, and I think at some level it's always be right. So, for instance, if we think about that, a large part of institutional money, your and my pension savings,
Right.
or in my insurance premiums that we pay to insurance companies, they get deployed into the bond market. So, whether we directly participate, indirectly, there is already these things being invested in for us, which I think already takes place. I think what has happened in the last 3, 4, 5 years has really been a direct participation.
Right.
Which, of course, the online bond platforms, and you've been part of one, has played a big role. And certainly that to me is very heartening. While you spoke to in rupee lakh crores, I like to keep converting numbers into USD billion. So let me just offer the audience sort of the numbers that I think I saw happen in the last 3 years, 4 years. On an average, the bond markets through the primary issuance in the EBP portal raised on an average greater than $100 billion each year for the last 3 years. Wow. Right. And when we talk about that kind of number in FY25, it was about 123 billion USD. When you compare that number to the equity market has been clocking about 25 to 30, $35 billion, right? So just by sheer magnitude, people should realize the bond market is way, way bigger.
Right.
When it comes to primary. I think when you shift gears to secondary, I think that is where equity is indeed reigns supreme.
Yes.
Yet, even in the bond markets, I would say secondary market has usually been about 15 to 18% turnover of issued bonds. That again in the last year has climbed up to about 22, 23%. And again, I think credit to the online bond platform folks. They have galvanized some of the retail interest, some of these trades. As a volume participant in the RFQ, I think retail participation has really seen,
Yes.
I would say, more than 3-digit jumps year on year. So that to me is very hard.
Lovely. So what do you think is driving this surge which you've seen in the last years? Is it just better regulation? Is it also the technology surge which has happened? Or is it just what you would say is investor fatigue in the last few years with equity? considering there has been COVID, there have been a splurge of people talking about finance on the internet. People's interest in finances have, at least from what I have seen, has increased tremendously since 2020, right? So, what do you think is the major reason, or is it a combination of all these?
Fatigue, which you mentioned, I have not seen. I think, that our IPO markets continue to do as well as they do. So people are not certainly tired yet of equity markets. But I think all the other factors that you mentioned have come together in a way, how people use the phrase perfect storm. So technology has bridged a lot of things. I think that our own markets have become electronic. Like I mentioned, the EBP, the RFQ, they have given price transparency, price discovery being achieved in a better way. Uh, People have been able to access far more information. And I think if you ask me, uh, it is also the period where whether influencers, whether authoritative commentators on television, electronic media, have called out this entire thing of what I describe as lazy banking. Right?
Mm.
Many people were quite okay leaving their money in the bank accounts, whether it's savings accounts, either converting them to FDs. I think they have awoken to the fact that you can actually get better yields, better returns, rather than leaving that money just at rest.
Right.
And putting money to work, I think that is where whether the equity market platforms with support or the debt markets, the OBP support, have really played a great role.
Right, so absolutely. And, you know, as you mentioned, this is something retail investors have recently sort of come into. And historically, bonds or the debt market has not been a retail investor play. What do you think were the structural barriers, or, were there regulatory barriers or tech barriers? What were the barriers for, keeping or preventing retail investors from exploring this market until so late?
So, two or three things actually. So, I'm a throwback to the years of 90s, where actually I saw a bunch of public issuances. I was part of an institution which sort of took, I think, issuance program, which was almost every month we were issuing bonds into the public.
Right.
So, ICICI umbrella bonds became very famous. ICICI
Absolutely.
bonds, they were branded as. IFCI, IDBI. I think each of us as an institution were tapping the bond markets dramatically. So were the corporate India. So I would just say that, 30 years back, there was an active public issuance of bonds. Again, the regulatory ecosystem was decent. It sort of was also responsive. So when we said we want to come into the market so frequently, I think the entire thing of shelf and being able to sort of say, okay, you can file a shelf document and you can issue underneath that. The regulator accepted it, and I think it got encoded even into a Companies Act, if you will.
Yes.
I think what has happened thereafter is that the banking system became far more prominent in the lives of corporate issuers.
Okay.
And sort of outpaced, therefore, the need and the reliance on the bond markets. So it's not that the public weren't responding to the bond issuances when they were happening, they were. But I think the bank market sort of overtook and made it easier, made it more convenient in many senses for those looking to raise monies to doing that. I think what we are now seeing is a cycle play out. So in this cycle, we have had banks which have had a NPA issue. We have had where the Reserve Bank has sort of nudged them into saying, please make greater provisions, please make greater capital adequacy. And at some level, the banks themselves have turned, if you ask me, I think a little bit risk averse, right?
Right.
So there is a migration to higher quality, maybe more diversified and therefore more retail focused rather than corporate lending. And therefore, the corporates have had to then figure out, okay, I need alternatives beyond banks. And I think that is why they are back in the bond markets. So all of it coming together has meant that again, there is a revival of issuer interest and of course, like I said, investor interest. We've had calamities. We've had ILFS, DHFL, etc. in the bond markets. But I think overall, the sentiment has become that, okay, we will give this a shot. Let's see how it pans out. the institutional safeguards of institutions being the large investors in these bonds. And they are, again, at very high levels of mobilization of monies that have happened, has again encouraged the issuers, I would say, into coming into this.
Absolutely. And, now let's come to how OBPPs are being termed as the retail revolution for the debt markets, right? And let's go back to the beginning. And I think both me and you were there at the beginning of this process, where SEBI had called on the players who at that time were unregulated in the market, and bonds became a sudden phenomenon amongst retail investors. So before we get into the regulation itself, if you could tell us SEBI's perspective at the time when these bond spaces were unregulated and public was showing so much interest, what was the thought process in terms of creating the regulation, and why would the regulator think that this is such an important space to regulate and develop?
I think as we saw the growth of 2 or 3 or 4 platforms emerge in the market, and what took us by surprise was the level of retail interest in those. So, there are many times when the number of investors interested is actually very little, and therefore it doesn't attract regulatory attention. I think in this particular case, it sort of woke up the regulator to saying, okay, there is investor appetite. I think that prompted both look at what was being distributed, whether there was uniformity in how it was being distributed, disclosures, grievance redressal, and so on. So I think all of it led to saying that can we and should we put in place a framework which sort of equalizes the market opportunity for both the uh, platforms, but also from an investor safeguarding perspective, what can be put in as measures. And I think that led to both the consultation paper getting issued, that led to a host of platforms responding to that, public responding to it.
Right.
And I think that ended up shaping how the regulatory framework which emerged.
Fantastic. And do you think that OBPPs are what maybe discount brokers were to equities? Do you think that is something which can grow so big and we can sort of use that statement as a comparison?
I would tend to agree. I would say yes. I think there comes again these tipping points in life. To me, that the discount brokers actually brought in both ease of technology, but also how people interacted with the market. So whether on their own phones, apps which made it very easy to sort of do so. I think that's the promise that the OBPPs also hold out. So yeah, I would tend to say that. And I think from a regulatory viewpoint, that they have got aggregated into the RFQ platform.
Yeah.
That there is uniformity in how they both disclose data, how they deal with issues which may crop up, and so on. I think that gives the regulator confidence of saying, okay, these platforms are probably evolving in the right way possible.
Right. And when we sort of came up with the regulations in the first place with the OBPP framework, at that time, listed debt, which was government security, was at a minimum face value of around 1 lakh. Eventually, we saw it drop down to 10,000 rupees. How big a role do you think that drop in the face value, or minimum face value of 10,000 rupees, played in the growth of retail participation in the investment of bonds?
So again, we took several measures, I would say, within the regulatory framework for encouraging the bond markets growing. And I think that reduction in face value was one amongst them. Of course, if you trace back, then even the 1 lakh was preceded by where the face value was held at 10 lakh rupees.
Right.
So there was anyway a mindset to sort of say we should have a glide path to keeping on reducing the face value. I think the balancing act which SEBI did was to saying while it's 10,000 rupees, we expect a merchant banker to be appointed,
Right.
because now this is akin to what in a public issue might be offered at 100 or 1,000 rupees, and the leap to 10,000 is not really too much. So I think it did play some role, but I think it's also a signaling effect, if you will, to issuers, to the platforms, to investors, that yes, we think this is an instrument you can sort of add to your portfolio.
Understood. And then, considering this drop in the face value, Do you still think that retail investors kind of still equate bonds with FDs as like a similar product? Do you think there's actual understanding that there is a significant difference in terms of yield, risk, and product type between these two products?
So one, I keep saying that Indian investor actually is very intelligent and probably gets the nuances, gets the differences. But it's also incumbent on the players and the ecosystem to make sure that the messaging is not distorted or direct. Uh, Bank FTs by nature and of course up to the regulatory prescription, statutory prescription is insured. There is a backstop from the DICGC and
At least up to 5 lakh rupees.
correct. So for somebody to equate corporate bonds with that, I think is not right at all. In terms of liquidity, again, you can go back to the branch which you got the FD from, with the FD, and sort of get liquidity instantly. I don't think bonds are there yet. So there are several differences. I think people are aware of them. I think the regulatory view or the stance should be that how do we create opportunities? For instance, a market making in bonds may end up giving the equivalent of a liquidity that a FD enjoys. But it's a very different thing from going back to the issuer and saying, I'm giving you back your instrument
Correct.
and give me so and so. So to my mind, that is one piece. And incidentally, one of the reforms which SEBI did introduce was it created a structured way for issuers to sort of say we will have put options at staggered intervals, which can be predefined, which mimic, if you will, a market making or a redemption sort of thing. While we consulted a lot of issuers about potential of harnessing that, we are yet to see any one issuer use that mechanism. So I'm looking forward to that being put to work. Similarly, I think the other thing which concerns bonds and how the evolution has sort of taken place is that the risk categorization, the rating sharpness, the linkage of risk and return. I think that is where the real both the test will come and the education really has to emphasize. If you are being richly rewarded by instrument, you can probably assume that there is a lot of risk embedded for which you are taking that reward. If you are, very near what a AAA or a bank FD rate is, then perhaps the risk is lower. And despite that, there is still a overall caution of saying there can be delays or there can be defaults.
Right.
I think that should be overall theme of bonds, which should play out.
Absolutely. And you touched upon an important topic, which sort of was my next question anyway, that, even today, after all this progress, and it's not been a long time, it's been a few years, liquidity still remains thin in the bond market. And I myself, having been part of an OBP previously, we've seen how liquidity is a challenge. And people do require, so you'll have sudden marriage requirements, kids requirements. They sort of don't want to have that money stuck in the bond for the 1 year, 2 year tenor. What do you think is the major challenge for liquidity in market? And you sort of dabbled in it for a few seconds while you were answering the previous question. But what do you think is the major challenge and what can be done to improve this situation?
So, one, I believe that it is maybe an impact of the kind of investors at the primary market itself. Like I said, if there is 80, 85, 90% of bond issuances that are picked up by institutions, such as pension funds, insurers, they are hold to maturity investors.
Yeah.
Right. Their liabilities on the other side are long term in nature. They will want the bond portfolio to match those liabilities or be proxy to supporting that ALM at some level. So they are not going to be in the market dealing and trading.
Right.
We used to have debt mutual funds which were probably both on the side of redemption pressures or inflows coming in, frequently trading in bonds. But again, the tax arbitrage which existed for them sort of disappeared. So with that, I would say we have had a little bit of withering. But Having said that, I mentioned about the turnover ratios right at the start of my comments. So I will go back to that. So normal turnover in bonds has been about 15 to 18%.
Right.
Uh, if you look at global standards, so let's say US is the largest bond issuance country and huge liquidity and so on. If you look at the turnover ratio there, it would probably be just around the same. Right? So I'm saying it's not unique to India. So we should not, keep punishing ourselves, keep saying that we have a very poor secondary market. The institutional construct of investors makes that a reality. What should we be doing and what we have done? I think one, the liquidity comes because there are people willing to make a trade or willing to sort of. At some level, aggregation of that liquidity on the RFQ platform has been one answer, right? So when we say that please route all your orders into RFQ, it is to try and make sure that that aggregation is really
Right.
happening. The second has been what I would call encouraging emergence of market makers. And for whatever reason, I think that's not happened in our country. Overseas, in fact, even for Indian corporates which issue foreign currency denominated instruments, the underwriters usually act as market makers. Right. So my question really to the market would be, well, why are you not asking your underwriters to play that role? And you need not play this role for the large institutional investors. Offer it at least to the retail.
Right.
Right. And that is where retail will sort of then come in and grow in numbers. I think the last piece, which is also a big jump up from where we were 3 years back to now, is this entire corporate bond repo platform. It didn't exist, or in the previous setup was moribund. I think the AMC repo clearing runs that platform. In very first 8 months or 9 months of its operation, the aggregate turnover reached about 4.1 billion USD.
Oh, wow.
Right. The next year, one full year of operation, it hit about $35 billion.
That's extensive.
Right. And this year, which is its third year of operation, and year to date, April to mid-December, the aggregate turnover has already hit 53 billion USD. So we now have a active corporate bond repo, which is giving liquidity to investors in AA and above securities.
Right.
And I keep saying, that it will actually go and skyrocket if banks and PDs, primary dealers, start to participate. If RBI puts one key enabler in place, which I think the SEBI would have requested RBI to consider. If that happens, this market will provide the necessary liquidity that is desired to be seen. Today, those who are using it are sophisticated institutions, using it for money management,
Right.
using it where indeed these bonds can support temporary cash flow requirements and so on. But to my mind, what objective you laid out, a household which has an emergency, has an unexpected spend requirement, such a market should become available to them also. And these volumes, and like I said, it's just a 2.5 year story. Tells me that there is immense potential.
That's true. And, usually people will talk about the presence of the number of people who are willing to buy and sell bonds. That's your basic requirement of a market making, as you said. And of course, AMC, Repo, etc. systems which sort of catalyze those numbers. But right now, don't you think that the primary issue, which I think in my experience I've seen, is that the number of people who are, even though they're staggering numbers on the rise, are still too few to have that sort of a secondary market liquidity effect as you talked about as in equities. So do you think that there is a requirement or something to the tune of a distribution mechanism like what AMFI mutual fund distributors have done for mutual funds over the last 20 years? Do you think a system like that in bonds is something which is firstly necessary? And second, if it is, then do you think the impact will be as emphatic as that of mutual fund distributors?
So I know this is a constant drumbeat that one keeps listening to. I would sort of say that mutual fund is very different from bond markets and from individual issuers of bonds and so on. A mutual fund scheme by design is meant to be diversified. It is meant to have an independent fund manager, independent of the distributor, so to speak, right? To me, bonds offer none of that. They neither offer diversification. They will be very instrument issuer specific product marketing that a distributor may end up doing. And I fear what the distributor may end up doing may amount to mis-selling because there is a issuer sitting and saying, I need this mobilized and give it. So I don't think the MFD is the right example for the bond platforms to sort of embrace. In fact, I would say, please consider that the nature is online, right? So I keep thinking that you don't need a feet on street. You don't need a physical network which does this. What probably the distribution solve that has to happen may have to come from, if you say, I don't know, pooled vehicles like a debt scheme of a mutual fund. But which a mutual fund distributor is anyway enabled to do. What are you going to do differently? And if I had to put a more challenge, I would say, what if there was a distributor who said, all I'm going to promote is Tata Steel shares or, Reliance Industries shares? You would feel very uncomfortable with that proposition. Right. And I would say that's exactly true the minute you strip out the equity and say it's a bond which is going to get promoted. So somewhere I feel the industry needs to rethink what it really wants for that distribution outreach. Is it people who are interested in fixed income instruments? Is it your platform which the people should reach and be satisfied with versus the instruments that are, I don't know, on issuance that week, that month or whatever? I think that is probably a thinking through that really needs to happen. But yeah, comparing with pooled vehicles which are well managed, which are independently governed, is not the right example where when it comes to a commission based distribution network.
Absolutely. And I mean, while I agree with you on, the portion where there is a possibility of mis-selling, I feel that maybe there is a middle ground which has to be reached in terms of maybe something like an authorized person / distributor framework where there is some amount of commission, which is, we have caps, like even on mutual fund distributors. But the ability of these partners to probably reach tier 2, tier 3 towns where people are not really aware of bonds as mutual funds did. Don't you think that might help the market grow in a particular way? Of course, as you said, we need to have some checks in terms of the mis-selling, make sure that commissions are not in a way that you're promoting bonds not appropriate for the particular investment.
So I come from a background of having seen too much, if you will, to sort of say history won't repeat itself. I think this phrase of this time it's different is never true. It's always usually, the same old, same old. I will take the example of agency network that lenders used, which is collection agents. Right? And again, it was necessary, deemed necessary by the lenders to effect recovery, to effect collections. And I think what happened collectively in the societal consciousness is that there was overreach by these guys, that there was misbehavior, misconduct, manhandling, and I think that led to an entire backlash about collection agents. I would tell you that if you had people who were hawking bonds, and I would say the riskiest issuer is probably willing to pay the highest commission.
Absolutely.
And the lowest risk issuer will probably pay the least. Now, if you incentivize somebody exactly on those lines, guess what is going to get sold?
Right.
And that what will get sold being the highest risk is probably more damaging because when that delay or default happens, which is why they are regarded as high risk, somebody will pay the price. I don't want it to be the OBP market sector or the issuers or investors paying that price. So at least that's the view that I hold of saying why that agency network may not be the right approach. Those who want to, I think, should be encouraged to actually saying, please do IPO style public issue of bonds.
Uh-huh.
And indeed, in equity, there is a public issue. There are syndicate, there
Right.
are sub-syndicate members. Hold them accountable and responsible. But they are part of the regulated ecosystem. MFDs are not regulated.
Oh.
Yes, the AMCs are responsible for them, but they are not regulated entities. To me, I would argue for that. But now, if you say, no, allow me to do EBP private placement,
Uh-huh.
listed basis, but distribution which is linked to it. I think those are not compatible sort of things. So yeah, that's at least my view. I don't know how strong it is or whatever. I'm not in the regulator's seat, but it is indeed for industry and the regulator to figure out what will work best.
No, it's of course lovely to hear perspectives, to understand why a certain decision has been taken or how, people who have been in the industry are thinking. And you talked about an important factor of trust, in the previous response. In the past few years, since 2022, when the regulations of OBPPs came in, we've seen a bunch of changes such as, uniformization of the GID, KID process for listed and private placement and public issue. The disclosures have become fairly the same. It's pretty much, actually, I don't think there's any difference left anymore between a private placement and a public issue. Um, these have sort of reshaped how the debt market has worked in the last few years in terms of trust. So which of these changes or which changes in this regulatory sense do you think have had the biggest impact in creating trust in an investor's mind towards a debt instrument?
I think it has been incrementalism that has worked best. I think there was effectively almost all aspects that could be improved or changed. I think that were focused on and done. Like you said, the disclosure regime itself being aligned to public issue.
Right.
And I think the logic there was that what is privately placed and listed can get distributed the next day to public.
Yes.
In which case, the disclosure should match what a public issue looks like. And I know that policymakers keep thinking, oh, there is not enough public issue happening. I would say yes, but what's happening on the ABP is exactly public too because it's listed. I think for a long time, data uh, providers and so on kept thinking what happens on EBP is private placement and therefore private debt
Right.
and not listed debt, right? I think all of those have also sort of been shaped and changed and so on. One of the biggest, which I think personally was a good sort of move and maybe brought in much more issuances, was the concept of once listed, always listed. I think just as in the case of equity, you can't say I've got equity issued and listed and then say, now I'm issuing another set which is not
Right.
listed at all. I think that equalizer of sort of saying that if a bond issuer has already issued a listed, whether privately placed or publicly issued bond, then any further future issuances should be listed. I think drove a lot more issuances into the market.
Right. And again, stemming from the concept of trust, and regulations have come up. We've seen a few orders and we've also seen a few unregistered platforms sort of pop up in the market where they should ideally be registered and come under the framework, but they have not been sort of functioning as such. Do you think these pose a threat to the investors and how big of a risk is it?
See, anything which is not registered is unregulated by definition. And unregulated players can be only doing maybe what is self-service, which is not supervised, not looked at by anybody. That self-serving kind of approach can be damaging to investors. So yes, a regulator should sort of step in and wherever brought to its notice, take action, shut these unregulated platforms down. I think again, both the stock exchanges, SEBI itself has a list of those that are authorized to be online bond platform. So investors before dealing in with these platforms should actually check both exchange listing or exchange websites or SEBI website. And I think that might be one way of overcoming it. The other which I fear is that distribution, especially in a digital world, can very quickly cross numbers which make it a public offer, right? We know that in a earlier Companies Act, that number was 50 or more.
Yes.
In the current Companies Act, it's 200 or more. I think many people forget that the digital ecosystem is not just hundreds, it's actually thousands and lakhs and millions in no time.
Yeah.
I fear for that. So I think at some level, that is where we should be guarding ourselves against. Whether issuers, intermediaries, I would say please stay away from unlisted and certainly don't bring them on digital platforms because, like I said, this growth can really be too much. And when that growth is too much and a delay default scenario happens, people will look askance at why didn't somebody stop this earlier
Right.
or nip it in the bud, right? I think that is why the regulatory actions need to happen.
Absolutely. And I think we have seen some measures in terms of verified UPI handles which have come in recently, where you have to have a green tick mark registered with the exchanges and SEBI, which gives some inclination to an investor that, a platform is a legitimate platform. But I still feel that, investors need to take some onus upon themselves. Because as you said, the information technically is already available. It's available on the SEBI website. It's available on the exchanges as a list of registered OBPPs. But the yields, sometimes attract them over common sense, if I could say so.
No, see, I end up thinking that there is both or maybe two or three factors. One is gullibility. Many people are gullible and sort of see somebody who speaks so authoritatively, so convincingly, that they probably just get led into that. The other is what you said, which is greed. So you know that when they think that okay, this is something which is a surefire return of X and Y, and my current regulated options don't give me that. Is why people sometimes go up that. I think between this gullibility and greed also lies the onus on us of making sure that we are educating them right about pitfalls. So I keep thinking about it that regulators end up creating alternatives for investors to have safety, to have comfort, to have redress mechanism, and so on, right? Take the classic case of digital gold. Again, maybe a history similar to online bond platforms 5 years ago or 6 that they started. The regulator called out and sort of said, intermediaries don't deal with this instrument. And then went on to saying, okay, let's do a consultation. And they created a regulated alternative called e-gold receipts. Right? And digital gold continues to flourish. E-gold receipt, by contrast, I looked up the numbers. From inception, from whenever the first exchange traded EGR happened, to date, the volume has been shockingly 100 crores. Right? And we are talking about 2.5, 3 years.
Yeah.
Digital gold, by contrast, has mobilized year on year, maybe 10, 12, 13, 15,000 right? crores. Now, I'm saying something has led the investor to saying, here's a regulated alternative, I'm not going for it. I'm going for an unregulated alternative. And again, in November, we saw the regulator call out and said, remember, it's unregulated.
Yes.
Remember, it is not governed by anything which securities market regulator looks at. So sometimes is the investor fully aware and doing what is appropriate? Is our ecosystem got to do more on education front, got to do more on here are these things which is available here, not here? I think these are what should confront us as practitioners and also market participants and ecosystem players.
Right. Absolutely right, sir. And, moving on from there, we have to now look ahead as to what are the next steps in the system, in this ecosystem, in this market. Yesterday's board meeting, in fact, put out a new, I would say a very nice sort of initiative and approval where in public issues, you can now have certain incentives for senior citizens or women to invest in bonds, which is what was existent in FDs for a while now. So in those lines, what do you think are the future innovations that are present in, the bond market or debt market which can come? I mean, we've seen more complex instruments in the market. Right now for retail, the regulation sort of restricted to simpler, what I would say vanilla bond structures. Do you think more complex bond products are the way of the next innovation, and are they actually suitable for retail investors, at least as of today or in the next few years?
So, I think I made that remark earlier, and I'll say that again. I think Indian investors are intelligent, are discerning. Yes, there can be some who fall prey to gullibility or
Right.
maybe greed, but by and large, people are uh, they get the risk, they get the return concept. I think complexity, if it is what is going to help the issuers as much as the investors, I'm all for it. Uh, I end up also thinking that when things are kept simpler, the growth is actually greater.
Right.
So think about it from an issuer's lens also. Does he really want a complexity in the instrument that is designed versus saying, here are the strict interest payment dates that I am aware of, I plan my cash flows around it and so on, versus saying I'm going to soup it up by giving maybe index linked returns.
Right.
And now somebody else has to go and hedge those returns and saying, okay, this is the cost of that hedge. Uh, and I'm saying this from experience. There was a time, one of our monthly series of bonds that ICICI did, we created actually deep discount bond, standard regular income bond, and one of the flavors we added was a linked bond. So it was linked to returns on Sensex or Nifty. This is, like I said, late 90s. And that instrument at that point in time got the least level of subscription, right? So again, I'm not saying that it's not possible to think that now that there is a equity culture, that there are people looking to maybe a return which is not just fixed, but also which can give a upside.
Right.
So I don't put it beyond the realm of possibility to say, yes, this can be done. But if it has to be done, somebody has to price that complexity, look at how do you hedge it. Because if you leave it unhedged, you are probably having an open-ended risk as a issue.
Absolutely.
So I think that will be the more challenging aspect. But is the investor ready? I think investors will surprise us. They are all, I think there with it. Yes, some costly lessons in the past, but I think most of them get get this.
So let me sort of, end this lovely conversation with, your final views on a question, which is, I guess, fairly common, but I would really love to hear your view on it. If you had to sort of think of one structural or regulatory or operational reform, either of the three, whatever you deem fit, uh, as the next big evolution in the bond market or in the debt market, rather, in the next few years, in the next 10 years, what do you think that would be or that should be?
I'll attempt, and I'll attempt it in maybe three parts.
Right, sir.
Not the three that you asked, but the three that come to my mind. I think one, I would love to see simpler issuer offer documents. Uh, if we can make it both simple for the issuer to have offer documents and which are relevant material enough for the investor to sort of look at, I think it will be a dramatic shift. And I take the comparison to the same thing you were talking about, that, when you go and go to a bank and take a FT, the form is all that you see, and maybe
Right.
on the reverse of it are the terms and conditions.
Absolutely.
It's not a complicated offer document. It's not a 30-page, 300-page, 600-page document. So can really we reach that level with the bonds? I think should be the level of thinking that we should have. Does it mean that disclosures have to be lesser or different? I think then we have to think about where can we place these disclosures? Can they be accessed on an exchange website? Can they be on a QR code on that same document to be able to go? Can a regulator, whenever it wants to inspect, see that yes, they were up to date on the date
Right.
that issuance happened? So I think that would be one big revolution, and I think it can transform how bond issuances take place. I think the second, and again, I've had mixed responses from people who talk to me about it. I keep believing that if SME IPO is any sort of, uh, you know,
Mm.
way of measuring the interest of investors, but also the entrepreneurs who set up the SMEs. Uh, just equity can't drive their growth. They
Right.
need debts. Can we have, therefore, an active debt market which brings the SME players also into issuing bonds? And this is where I'll come to the third item, which is we need a mindset shift, right? So the mindset shift is this. Too many times we keep criticizing ourselves on saying we have a underdeveloped debt market. I would say people who are saying that have no idea what this country has achieved in the last not 20 years, not 15 years, last 5 years. I think you've been part of that revolution. I've certainly witnessed it at close quarters. And that to me is the mindset shift that we need. When I told you it has been averaging $100 billion issuances in the last 3, 4 years, you were surprised.
Yeah.
Right? And I'm saying when you now put it in context of the equity IPOs and you realize that it's almost 3 times, 4 times that number is what our policymakers need to recognize as this is a changed reality of our debt markets. Yes, our secondary market is shallow, but I explained why it is shallow. So I think again trying to say that we need to do something. Well, if your institutions are going to hold to maturity, there's nobody else who will come in trade. So you need to think about. I think that mindset shift. The last piece of the mindset shift is, especially those who devise a lot of policies. There are at least 10 schemes which are offered by the government of India to encourage the banking sector to lend to MSMEs.
Right.
Right. And then you turn around and tell the bond markets you aren't growing. You've given fuel to the banking sector to keep growing that book,
Right.
to keep doing it on taxpayer subsidy. The bond market has nothing which is received. I would just say, please give equal treatment.
Absolutely.
Please figure out a way for issuers and underwriters to be able to get the same privilege of what you give banks. And you watch this bond market will outpace banking market. And despite all of that, by the way, with all the fillers which the government gives with the 10 schemes or 12 schemes for the corporate, for the banking sector, the corporate bond market is today about pacing itself at equal to about 60, 65, 70% of incremental corporate lending by banks, right? So in India, we now have two engines of growth for the corporate sector. We have an active bond market and we have the bank market.
Right.
And the bank market is subsidized, is supported by multiple government schemes year after year. And this bond market has grown up on its own. I feel like, this is that orphan which they are not wanting to adopt, but keep saying, isse jada karo, iske become as good as, the banks. Please just treat them equally and they will surprise you, is what I will say.
So, fantastic to hear your thoughts, sir. And again, thank you so much. As always, it's always a pleasure and enlightening to have a conversation with you. And we hope that we have, given some more food for thought to regulators, investors, and maybe the government alike from what you've said. It's certainly been enlightening for me being in the industry. So I do hope that it's a lot more enlightening for the people who are listening to this podcast. Thank you again.
Thank you. Thank you for having me.